Now, we never got the break of 40 the first time. We got a very nice lift, and then we saw the failed auction here. So I was needing a lower price. That's what I said to the guys in the room at the time. I said, I'm going to be needing a lower price before I start getting back into this. We got the lower price, but we didn't just get the lower price. You can see the purple line is making a higher high against a rising crack spread. So the crack spread's going up, which is good news. The Brent oil spread is going up, which is good news. And then the drop that comes through the oil there gives us a separation on the purple line. What does the separation mean? Well, if I sell the purple line, what am I selling? RBOB, what am I buying? 2 oil contracts. If I buy the orange line, what am I buying? I'm buying RBOB and I'm selling 1 oil contract. What have I got left over? I've got a single oil contract left over at that stage. Single long oil contract left over at that stage, guys. A single long oil. So if I've got a single long oil contract, I'm trying to be long into that area, surely, because that's what the market is sloping up. I've got a single long oil trade. Why should I not want to be on that deal? It's not good. This one is very good because of the slope. When the crack spread is dropping and we've got that single oil contract, it's good, but it's not as good as if the crack spread's rising. We can see the crack spread was rising and the Brent WTI spread was rising and we were getting a lower price. And then we also see that that extra oil contract becomes my oil contract. It becomes my ability to buy into that storyline, and boom, straight up for a great profit off a level we'd already given out this morning. What about this one? Well, this isn't as good, but it's also relatively good. Number one, we're back at 40. Number two, we can see the crack spread has dropped off a little bit, which is why we're a little bit concerned, but it flattens just at the right time. But we do see an uptick in the Brent WTI spreads. So in that world there, when I see that acceleration in the purple there and I see that acceleration in the purple there, that's been caused by the oil price falling. So that's what gives us that spare oil trade, that spare oil contract on the 79.40s. And from 79.40, we've just traded back up to 80 evens again. Now, a lot of people always marvel at these massive big sells and big buys that we see in oil, $1,000, $2,000 trades in oil. But they don't really marvel at these trades because they don't go as far. But when you think about it, that trade was 500, that trade was about $700, $800. It's 1,200. That trade was 500, 1,700. That trade was 500. That's $2,200. That trade's 500. That's $2,700 profit on a single oil contract since 8 o'clock this morning. That's more than the vast majority of any trend you'll ever see on oil. Not in all the trends, of course, but that's more than the majority of all the trends you'll ever see. So when we see that setting up, we know it's got a short-term duration. Why? Well, because we can see where it is in the big picture of things. If we look at the big picture, we can see that the big sell that we had in that massive value divergence from this phase here, the sell we got, remember we gave out a classroom yesterday. And the classroom we said yesterday was a fair value price of $82.50. I said that there was a buy trade at $81.50 and a sell trade at $83.50. Does everybody remember that classroom? We said fair value was $82.50 and a sell was $83.50. The price traded $84.50. From $83.50. From $83.50, guys, the trade went down to $78. The sell was worth $5,000 straight line. $5,000. By paying attention to what we said in the classroom about where the sell was located, where the sell could have been available for any one of you at that point. And into the very bottom edge, what did we get? We got the cash close effectively right there, didn't we? We got the RGL right there. James would be happy with that one. Because if that's your RGL, the first thing that happened was the market went straight up and it's never went back down again. So your buy trade on the RGL was 78.50s. The high price was 80. $1,500 per contract maximum swing for James. And I say James because as far as I'm aware, James is the only one that's trading these RGLs and making an absolute fortune from them as well. Making a fortune from them. I hope making a fortune from them. So when we see these as opportunities, you know, we start to recognize a lot of things inside of these worlds, inside of these narratives. And obviously it's very, very important that we get some other reads, some other ideas. We talked about, for example, inflation break-evens. Is inflation perkier to the upside or not? That's the big question today, isn't it? Well, let's take a look at inflation break-evens in terms of the macro structures. And when we're looking at this chart, this is probably the best way to look at the chart, is to try and look at the big ideas, the big macros on this. The big macros improved significantly yesterday. They dropped off, and then this morning, they have dropped off a little bit, but have they dropped off to that extent? Have they dropped off to that extent, or are you still bullish oil at lower prices? It looks as if you're really bullish at lower prices based on the bond trading desks, doesn't it? The bond trading desks are simply looking at this lower price and saying, you know what, if you don't buy that RGL there, you are an absolute mug. Because that's exactly what you are if you don't buy that oil RGL and you're an oil trader, because you're an absolute mug for missing out on one of the best easy money opportunities. The inflation break-evens are massively divergent at the close, so you should be long, absolutely, no question, you should be long oil. But into today's open, it's not bullish and it's not bearish. It's definitely bullish at lower prices, that's for sure. But it could also be bearish, probably up towards $81. I would imagine everybody would agree that if it was to trade 81 bucks, looking at the inflation break-evens, you'd probably think there's a bit of value in that for a short trade. So fair enough, I've now got a range that I can work with. I've now got some ideas. The other challenge, of course, is what's the dollar been up to? And you can see the dollar has been, well, what has the dollar been up to? You can see the dollar's been kind of neutral for the commodity currencies just now. But it's not as important just now, is it, the dollar? Because the dollar's obviously very, very heavily impacted by the Fed. It's got nothing to do specifically with oil. So I'm not as inclined to be looking at the Forex markets as a read for my oil trades at this stage. What about the calendars? Let's take a look at the calendars going out through to March next year. What are the calendars suggesting? Well, probably quite bullish. Would you agree with that? Probably quite bullish. Would you agree with that, guys? Calendars are a little bit bullish. Because if we look to the left and we look at the calendars here, would we all agree that they're about the same as the calendars in the background here? Would we all agree they're about the same as the calendars in the background? Now, if we all agree that they're the same as the calendars, these calendars should be naturally reducing, shouldn't they? Over time, they should be naturally reducing because the calendar always goes to zero, doesn't it? Otherwise, you've got an arbitrage. That's what calendars do. It's like buying volatility. The difference between volatility 1 and volatility cash becomes zero at one stage, and that's the cash close, right? The final settlement close. So this has a natural negative bias to it. It's got to have a natural negative bias, especially if you use contract 1 minus the other contracts. It's got a naturally downward sloping angle. So anytime we see an angle that's absolutely straight over quite a long period, that's already giving me an idea that it needs to be, you have to take that into consideration is what I'm saying, okay? But even without that, what's the lowest price of oil during that period? The lowest price of oil during that period was this pin rejection here, wasn't it? So during that period, the lowest price of oil was at that level right there. So based on that, would you all agree that this is way, way, way lower by, probably about $2,000? That oil prices are lower by about $2,000 than the calendar spread suggests they should be. So on that basis, should I be buying some oil off of these areas? Damn tootin' right I should be. Abso-fucking-lutely. So we've now got a full story. we've got pretty much the whole story to buy this price into that $79.50. We've got calendars in line. We've got the floating stock of oil in line, crack spread, Brent WTI spreads. We've got the inflation break-evens in line. None of them are brilliant, by the way. No, I'm not saying that. None of them are brilliant trades. What I am saying is that they are all buys on dips. Every single one of them is a buy on dips. So based on those buys on dips, is this trade turned out to be an absolute cracking call? Absolutely. Absolutely. So when we see these as cracking calls, you can see just how good this trade has been to us all morning. You can see how it's played out. You can see it's been, as I said, nearly a $3,000 profit buying the lows. Am I holding on to buying higher prices? Not really. I don't like it much above 80, but I'm not bothered about it above 80. But I'm not holding on to much business above 80s. If it breaks higher, I'll still be in some. But if it breaks lower, I'll close out my position and I'll start buying the damn thing all over again, right? I'll start buying it all over again. So for me, it's an exit. It's a walk away. I'm quite happy with that. And as I said, we're on target to do $3,000 a contract on oil, all from the buy side today. Every single lot is from the buy side. Why else? Because take a look at equities. What are equities doing? Equities and oil have a strong positive correlation most of the time. So equities are having a very, very good update today. So on that basis, I'm more likely to be bullish oil than bearish, correct? You all agree? We've got a risk on sentiment, yes or no? Risk on sentiment, yes or no? Well, if I tell you we've got a risk on sentiment, would you agree with that? Of course you would. So if we've got a risk on sentiment, what direction should oil prices be going in? What direction should oil prices be going in a risk on sentiment? They should be going higher, right? So if we've got a risk on sentiment, did we get a risk on sentiment from the 8 o'clock open in London, yes or no? From yesterday's classroom, did we get a risk on sentiment at 8 o'clock, London open, on the first 15-minute bar? There's the London open candle right there. See it? 8 o'clock. 8 o'clock to 8:15. That's that huge green candle. What is the sentiment for the day at this stage? What is the sentiment for the day at this stage? It's massively bullish, correct? Right there. Massively bullish. Did we do this in classroom yesterday, Melvin? Yes, we did. Did we do this in classroom yesterday, Klaus? Yes, we did. So everybody knows that we have a massively bullish risk-on sentiment today. So on that basis, if we know we've got risk on sentiment, is it better to be buying oil at the lows? Absolutely. And what's happened? Oil's made a brilliant upside move, and the equity markets are still making high. I don't know if the equities are going to be bullish at the cash open. I'll get a new read into this cash open, won't we? We'll get a new read as soon as this cash open really starts giving us some information. That long euro trade, by the way, made some nice money. Long euro trade made some really nice money, by the way, so that was pretty good. That was pretty good. The interesting thing is on the Russell, the dealers were actually still buying into the, well, yeah, they've still got a withdrawal of liquidity above the market there, but they've certainly absorbed all the buying there at 30 and they've sold it. I didn't think they were going to buy the Open. I said that earlier to the guys this morning. I think they'll probably sell the US Open simply because there's an opportunity to lock in a huge profit. And obviously because we had the big pop on non-farm payrolls, it kind of put people into the mood of saying, well, we've got to just be a little bit kind of risky with this, a little bit risky holding on to some business into these higher prints, isn't it? It's a little bit risky. So obviously a nice opportunity just to lock in some nice cash. So we've had a good day today, guys. Very good day. Love it long time. There's what's happening on oil. We said we're going to take profits at 80, so we've caused the price to just drop off a little bit. And we'll obviously be watching to see if that gives us any buyable opportunities on on a pullback to come back in again for an afternoon session. But I don't really think the American afternoon's got much for me, because I think the US equity session is probably going to be rotational. And, you know, because I think the US equities is probably going to be rotational, I've probably got the same feeling about oil. So I think I'm probably finished for the day, guys. I don't think I'll do any more business today. I'm quite happy with my my lot today, I think. But if I get a good discount on oil, I'm certainly going to be keen to buy straight back into it. I think we've got a lot of room to maneuver, probably about another $500 to $1,000 on oil on the upside. So if I get a good discount on oil, I'm certainly not going to be scared to come back in and buy up that discount as aggressively as we can and see if we can take the price up to maybe 80.5. At a stretch, maybe even 81s if the value comes back in behind it. But I don't know if we'll get that. I'm not sure what kind of afternoon we'll get. I'm not really interested just now, and I'm going to grab a bit of lunch. I'm going to grab a little bit of lunch, and when I come back, we'll see where we're at to pick up some business.